If you're wondering how the new Nigeria Tax Act affects you, then this video is for you. Hi, I'm Jadisola Akingbola. I share practical financial advice to help you manage your money with intentionality and clarity. So in this video, I'll do my best to explain what you need to know about the new Nigeria Tax Act as regards personal income tax. But before I go right into that, I would love to say that the conversation of taxation here in Nigeria is now more present in the minds of everyone than ever before, probably since our independence, and that is a big kudos to the tax reforms team. In my opinion, more funds in the hands of the government can actually do more good for Nigeria, sentiments aside. One more thing before we kick right into this video, I would love for you to stick to the end of this video because I have something waiting for you. So delving right into the matter of the day, what is personal income tax? Personal income tax, PIT, is a tax individuals pay on income earned on all sources, that is from your salaries, business profits, investment gains, and other taxable receipts within a year. As a registered business here in Nigeria, the law sees you, the business owner, as the same as the business. So your business profits will be charged tax under personal income tax. So now let's look at the core changes that the personal income tax has in the new Nigeria Tax Act. So the first change I'd like to talk about are the new progressive tax bands and rates. The new act introduced progressive tax brackets, which allow, in simple terms, those who earn more to pay more and those who earn less pay less effective tax on their taxable income. As you can see in the table displayed on the screen, the first 800,000 naira of your income is tax-free. That is 0% tax will be paid on the first 800,000 naira of your income. This allows relief to low income earners, that is those who earn less than 67,000 naira per month. The act also allows that different portions of your income is taxed at different rates, increasing as your income increases. So let me explain. Let's say you earn 3.6 million naira a year, and without reliefs, your taxable income falls to 3.6 million naira a year. This is what the new tax band and rates say. The first 800,000 naira of your income will be 0%. So the next 2.2 million naira, which is what will bring your income to 3 million, the next tax band will be taxed at 15%, which is 330,000 naira. The next 600,000 naira, which is what will make the complete 3.6 million naira, which is your taxable income for the year. The next 600,000 will be taxed at the applicable rate, which is 18%, giving 108,000 naira. So that brings your annual tax payable to 438,000 naira for that year. The next change is tax exemptions, reliefs, and deductibles. We already spoke about the first 800,000 naira, which is tax exempt, that is 0% will be charged. Also, the new tax act allows for compensation for loss of employment and personal injury to be exempt up to 50 million naira. So what does that mean? If you were laid redundant and compensated with an amount, if the compensation is less than 50 million naira, you will not be required to pay personal income tax. However, if the compensation falls above 50 million naira, you will be required to pay personal income tax on the excess of the 50 million naira using the applicable rate. Also, if you incurred any personal injury in the course of doing your work and your employer compensates you with an amount, if the compensation falls above 50 million naira, the excess of 50 million naira will be charged using the applicable PIT rate. The new Tax Act also maintains deductibles that were in the old Tax Act, such as pension contributions, National Housing Fund, National Health Insurance schemes, and also life insurance premiums. So those will still be allowed to be deducted from your annual income to arrive at your taxable income. It is important to note that supporting documents have to be kept for each of these things to prove that they were actually incurred in that year. Also, the old consolidated relief allowance has been replaced in the new Tax Act with what is called the rent relief benefit, which allows you to deduct 20% of your rent from your annual income to arrive at your taxable income. However, 20% of your rent is capped at 500,000 naira. So this means that if 20% of your rent falls above 500,000 naira, all that you will be allowed to deduct from your annual income before arriving at your taxable income is 500,000 naira. Whether or not this is fair is still being debated, but for now, this is what the Act allows. The next change is residency rule clarifications. The new Tax Act defines tax residency more clearly. A resident individual is someone who spends 183 days or more in Nigeria in a year, maintains a permanent home here, or has strong economic or immediate family ties. Residents are taxed on their worldwide income, while non-residents are taxed only on income earned in Nigeria. So what does that mean? If you are residents here in Nigeria and you earn income from other countries, your income globally is subject to personal income tax. But if you are not resident and you earn income here in Nigeria, PIT will only apply to the income earned in Nigeria. The next change we find in the new Nigeria Tax Act is a broader tax base. Taxable income now explicitly includes digital and virtual asset gains, prizes, honorarium, and grants. That is, when you receive prizes, let's say for competitions, now those prizes are subject to personal income tax. The Act also defines valuations of benefits in kind, like rent-free housing capped at 20% of gross income and employer-provided tools limited to 5% of cost. So this is how PIT is calculated. Start with your total income for the year. Subtract allowable deductions such as pension, NHF, NHIS, documented relief up to 500,000 naira. The result is your taxable income, and then apply the progressive tax band to your taxable income, just as was earlier explained in the video. PIT is filed not later than 31st March of the next year. So you want to make sure that at the end of the year, you have identified your total income. That is, whether you're a salary earner, a trader, a business owner, whatever it is you do, you have identified all your total income from all income sources. Also, businesses not registered as a company, you want to make sure that you have identified your business profits, which is your revenue minus your expenses. All of these documents will be filed at your state tax office. So you also want to make sure that proper records are kept so that the correct amount of tax is paid. Make sure to have your tax identification number. For employees whose employers already remit PIT on their behalf, that is the pay as you earn, they would already have their tax identification number because this is how your employer will remit taxes for you. They will require your tax ID to remit your PIT to your state tax office. But if you are not under an employment, or if you do not have an employer who remits taxes on your behalf, then before the end of the year, you want to make sure that you have your tax identification number so that before 31st March of the next year, you already have your tax identification number with which all your returns will be filed and your tax paid. Now that we are at the end of this video, here is what I have for you. I have created a detailed Excel template to help you calculate your personal income tax. All you have to do is download with the link in the description. Remember to like, share, and most importantly, subscribe so that you do not miss new videos I share on this journey of helping you manage your money with intentionality and clarity. Also, feel free to drop your questions or comments in the comment section, and I'll be happy to respond to you. Thanks for watching this video, and I'll see you in my next video.